Welcome to Talk Tickers, the deep dive into earnings calls where we bring you the essential info fast.
Glad to be here.
Today we're digging into Socit Gnrale and the big story, a really strong first quarter.
Absolutely. The call really highlighted some significant progress, particularly on key financials.
So let's break that down. First up, revenues saw a big jump, right? Actually beating their full year target already.
That's right. And it's interesting, if you exclude some asset disposals, mostly Morocco, and some private banking stuff, the underlying growth, even stronger, shows good organic performance.
Okay, so not just disposals propping it up.
No, definitely not.
And it wasn't just revenue. They also managed substantial cost cuts, leading to a better cost-to-income ratio than expected.
Exactly. That ratio is key for efficiency, and getting it down like that ahead of their own target for the year, that's impressive.
Right. And all that flows down to the bottom line. Profitability looks sharp. Rotee well ahead of guidance. Remind us, Rotee is?
Return on tangible equity. Basically, how well they're using shareholder money to make profit.
Got it. And they beat their own forecast there, too.
Comfortably, yes. Strong Q1 profitability.
And finally, it sounds like the capital position is solid. No worries there.
Seems very robust. Their CET1 ratio, that's the Common Equity Tier 1, a core measure of bank strength, it's looking good. Comfortably above regulatory minimums, above their own targets, even factoring in Basel IV impacts.
So a good buffer.
A significant buffer, yeah.
Okay, so overall tone from the call, pretty positive, reflecting strong performance. Let's dig a bit deeper, though. That revenue growth you mentioned, stripping out disposals, what were the specific engines driving that underlying growth?
Well, French retail was strong, private banking too, and insurance saw a nice boost from fees.
Okay.
And then there's global banking and investor solutions. They really benefited from the market conditions, particularly equities trading, financing, and advisory were also strong contributors.
Right, volatility helping the trading desks.
Seems so. And even mobility and international retail showed growth once you adjust for those disposals. So it's quite broad-based, really.
Sounds like things are clicking across the board. Now, those cost reductions, where did they find the savings? Was it just cutting staff?
A big piece was lower transformation charges. The costs tied to restructuring or tech upgrades.
Ah, okay. Less one-off stuff.
Exactly. But beyond that, they improved operating leverage pretty much everywhere. Basically, revenue grew faster than their day-to-day running costs.
And that feeds directly into that better cost-to-income ratio we mentioned earlier.
Precisely. It really highlights that combination of revenue growth and disciplined cost management.
Now, given the, let's say, interesting economic climate, risk management is always top of mind.
Yeah.
What did the call tell us about their approach?
Well, the headline cost of risk is still low, well within their guidance range.
Okay, good.
But interestingly, they did increase their stage 1 provisions.
Stage 1. That's for loans that aren't yet impaired, but where risk might be increasing.
Exactly. It signals a bit of caution, setting aside more for potential future losses given the uncertainty out there. But overall, asset quality still looks sound. The NPL ratio non-performing loans is stable, and their coverage for those loans is solid.
So watchful waiting on the risk front, but stable for now.
Yeah.
Let's circle back to that capital strength, the CET1 ratio. What's building that up?
A big part is organic capital generation, just making profits.
Makes sense.
And those asset disposals we talked about, they also gave it a boost. Now, there was an offset from implementing something called positive war. It's a Basel IV risk weighting adjustment, but the net effect is still a very strong capital level.
Right. And liquidity.
Yeah.
Can they meet their obligations easily, short and long term?
Yeah, the liquidity profile looks very strong. Both the LCR liquidity coverage ratio for short-term needs and the NSFR net stable funding ratio for the longer term are well above the required minimums. They've got significant liquidity reserves, mostly cash sitting with central banks. They've also done a good chunk of their long-term funding plan for the year already. And the deposit base, still nicely granular and diversified, though it ticked down slightly, which they said was in line with their steering targets. Loan to deposit ratio looks healthy too.
Sounds like they're sitting pretty comfortably, financially speaking. Okay, let's shift gears and look at the specific business segments. French retail, private banking, and insurance. How did that area perform?
Very well. Strong revenue growth, again, excluding those disposals, and they kept costs tight. So you saw a really significant jump in the cost-to-income ratio for that division and strong returns. Oh, and notably, new home loan production in France was way up.
Interesting. So strengthen the core home market. What about global banking and investor solutions? You said they did well with market conditions?
Yes, very strong revenue there. Driven by global markets, they actually had a record quarter in equities trading, likely helped by all the market chop.
Volatility is their friend sometimes.
It can be. Financial advisory was also up. And importantly, they kept costs in check there too, so it really boosted the division's overall profit contribution.
So market conditions working in their favor there. How about international retail outside France?
Overall growth there too, mostly driven by Europe. Home lending was strong there as well. Africa was a bit more stable, less dramatic growth.
Okay. And the mobility and financial services bit, that's like car loans and consumer finance.
Exactly. Revenues there were pretty stable overall. Margins in the mobility part are increasing, which is good. Consumer finance saw revenues hold steady, and the pace of loan book decline slowed down.
Yeah.
So overall, that pillar's net income was up, helped by cost control and lower cost of risk.
Right. So even the more stable segments are contributing positively. What about the corporate center? Often drag, right?
It was actually near break even this time, which is an improvement, partly due to managing excess liquidity better, lower transformation costs, and also some accounting effects from those disposals we keep mentioning.
Got it. Increasingly important now, ESG, environmental, social, governance. Any updates on that front from the call?
They touched on it, said they're progressing along their ESG roadmap, focusing on the emissions footprint of their loan book and supporting the energy transition. They also mentioned getting positive recognition from ESG rating agencies.
So ticking the boxes there. Okay, looking ahead, what was management's tone on the outlook? Confident? Cautious?
I'd say cautiously optimistic. They express confidence in navigating the uncertain environment, pointing to their strong capital, diversification, risk management.
Usual pillars.
Right. They haven't hinted they expect to outperform their full-year targets based on their central scenario.
Oh, interesting. Did they raise guidance then?
No, they specifically said they're not updating formal guidance right now, probably prudent, but they did stress that ongoing cost reduction remains a key focus.
Makes sense. Keep costs down, ride out the uncertainty. And finally, that strong capital position. What are they planning to do with all that excess capital?
Good question. They said with capital comfortably above their 13% target, the board is looking at options. Could be distributions to shareholders, dividends, buybacks, could be investing in organic growth, or maybe even some inorganic growth like acquisitions.
But no firm decision yet.
Not yet. They basically said they'll make those calls once there's more clarity on the final Basel IV rules, specifically FRTB, that's the fundamental review of the trading book.
Ah, the regulatory piece again. Okay, so summing up from an investor perspective, it sounds like Socit Gnrale is executing well.
Yeah, the results really point to a company hitting its strategic marks, delivering on costs, and making the most of good conditions in areas like trading. And that strong capital base, it gives them a lot of flexibility for what comes next, including potentially returning more to shareholders.
And that caution we heard, the increased provisions.
That just signals prudence, I think. Acknowledging the risks out there, managing them responsibly.
And the different performance across segments, like equities booming versus steadier parts.
It just shows you where the growth drivers are right now, highlights the strengths, maybe some areas that are less dynamic, useful insight.
And the relentless focus on costs.
Suggests they're serious about long-term efficiency and profitability. Always good to see.
So the big potential catalyst seems to be that capital return story, maybe later in the year.
Definitely one to watch. Once that regulatory fog around FRTB lifts, the possibility of bigger buybacks or dividends could really move the needle for investors.
All right, so you've heard the deep dive. Strong capital, potential payouts down the road post-regulation, and a global markets division, especially equities, that's absolutely humming. Which brings us to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea.
Okay, let's think about this. You've got that capital strength, the clear signal about shareholder returns once FRTB is sorted, and that equities engine firing. So here's a thought.
Lay on this.
How about this? Go long Socit Gnrale stock, but hedge it. Short a broad European financials ETF. Crucially, one that excludes Socit Gnrale itself.
Okay, interesting. A pair trade, essentially. Walk us through the logic.
Right. The idea is to isolate the Socit's specific potential. If FRTB lands favorably or just predictably, the market could reward Socit with those buybacks or dividends we talked about. That boosts the stock. Plus, their demonstrated strength in equities suggests they might keep outperforming if volatility stays high. By shorting the wider sector ETF without CSIRA in it, you're trying to hedge out some of the general economic risks hitting European banks. You're betting specifically on CSIRA's capital return story and their trading prowess relative to the rest of the sector.
So what's the outrageous part? Sounds almost reasonable.
Well, pinning a trade on a specific regulatory outcome is always tricky, right? That's inherently risky. And betting that one bank's trading desk will keep outperforming the pack indefinitely.
Yeah, that's a bold call too.
Fair enough. And the plausible part. Management has literally said they plan to act on excess capital post-FRTB. That's a clear signal. And the Q1 trading results aren't hypothetical, they actually happened. It shows they can perform in these conditions. So it's not just a wild guess. It's based on stated intentions and recent demonstrated strength.
A calculated risk, perhaps? But remember, everyone, loud and clear. This is just an idea to kick around. It is absolutely not financial advice for your specific situation. Do your own homework, seriously.
Couldn't stress that enough. Your own research is paramount.
Okay, that wraps up our deep dive on Socit Generale's latest earnings. We've hit the key numbers, the strategy points, the outlook, and even floated a speculative trade concept.
A pretty comprehensive look at their Q1.
What stood out most to you from all this was the capital strength, the equities performance, the cost discipline.
All important pieces of the puzzle for anyone following the stock, I think.
Definitely. And as always, while things look strong now, the future's always uncertain. Keep an eye on those regulatory developments and the wider economy.
Absolutely. Ongoing monitoring is key.
Thanks for tuning in to Talk Tickers. Got questions? Or another earnings call you want us to tackle? Let us know. We're always ready for the next deep dive.
Yeah, send us your suggestions.
Until next time, happy ticker watching.